so many takeaways on that. Applies the stuff makes it more similar. Find any of should pick it up. Now we'll take us more demos on how to think or swim out of the education center on TV.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support. Push you to be even better. It just might change how you trade. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
How is your those who see upswings and downswings. Those who manage risk and obstacle executed strategy, a measured approach, right tools, driving accuracy. CME Group needs opportunity.
When traders tell us how to make Thinkorswim even better, listen. Like Jack, wanted a streamlined version to get access anywhere, no download necessary. And Kim, she wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web.
Plan for making your first trade. And so today we'll focus on exit decisions and considerations, and we'll review some of the tools used for trade exit. Now, to get us started, we'll be bringing in our friend Cameron May to discuss exit methodology. Now, Cameron is a senior manager and education coach of trading and education with TD Ameritrade. So Cameron, let's talk again about trade exits. This is a topic that we seem to come back to quite often, and it's a part of this discussion in this final week of answering the question when to get out of a trade. So they seem to be a stumbling block for a lot of traders. Why the difficulty in exiting a trade, Cameron?
Yeah, well, Ben, we got to remember that an exit represents the definitive close of the trade, and that notches a win or a loss for the trader. And that really gets mixed up in some of the psychological challenges that many traders feel like, am I exiting at the right time? If I leave the trade on, will I win more or maybe even lose more? Maybe if I just leave it one more day, it'll turn around. Now, because of these sorts of thoughts, Ben, some traders tend to stick their heads in the sand and make some random exit decisions.
Yeah, and being random when it comes to trading, Cameron, doesn't seem to be a great way to either enter or exit a trade. So I've got to ask the question, is there a better way?
Yeah, Ben, perhaps there is a better way to approach exits. It's really the idea of having a plan for exiting a trade before it's entered. It's using the phrase, if this, then that. It's looking at managing risk by drawing a line in the sand so that there isn't a question about when a trade should be closed down. And it's having a plan for re-entry if circumstances allow. So these are some of the considerations and concepts about trade exits that traders might keep in mind when they're placing that trade, Ben.
Yeah, Cameron, amongst all of the many things that a trader has to keep in mind, that understanding of the stocks that they're going to trade, looking for those stocks, looking for entry considerations, and going through that rundown of entry, maybe that entry checklist that we talked about, the idea of managing risk. Adding this on as far as exits are concerned, that's a lot to keep in mind. So why are these things, these considerations, so important, Cameron?
Yeah, well, as I mentioned, exiting a trade is, or, at least it can be, an emotional decision. So we talked earlier this season about some of the psychological challenges to exiting trades at the right time, Ben. And one of those challenges, what we call loss aversion, often leads to exiting winning trades too soon and not exiting losing trades soon enough. Those are, probably subjective decisions, and traders can remove some of the subjectivity from the process by simply using stop orders. We've talked about the if this, then that structure of exits, and it can be interpreted as a basic conditional statement. Anyone familiar with computer coding or software development will likely recognize this. It essentially means that if a certain condition is met, that's the if part, then a specific action will occur, or in other words, the then part. However, if the condition is not met, the action just won't occur. And the simplest example of this, or how it relates to trading, is the use of a stop order, Ben.
So to kind of remove that emotion from the equation, for instance, if price breaks below a certain level, then that if then else methodology triggers an order to exit the trade, and that takes the trader's emotion out of the equation. Is that right, Cameron?
Exactly. Yeah, that's how a sell stop order works. One great thing about sell stop orders is that they force you to think and consider when you want to exit the trade before the exit actually occurs, and that speaks to having an exit plan. And by entering that sell stop order up front, you're automating the exit. Of course, it's also important to remember that stop orders are not guarantees of where the order will get filled, Ben.
So we've spent a fair amount of time on your first trade, Cameron, about the different types of stop orders, and we're going to demonstrate some of those today, both in the next segment and when we bring you back to talk about a specific trade. But I know that stops aren't necessarily the first step in deciding when to exit a trade. Can we dig a little bit deeper into that idea?
Yeah, sure. Yeah, absolutely. Now, first and foremost, we need to decide when it's the right time to exit the trade. Now, generally, that means determining if it's a swing trade or a trend trade, Ben. Now, in a swing trade, we may have two exit points. One exit is if the trade hits a take profit level, and one if the stock moves, in the opposite direction. In a trend trade, usually the exit comes if the stock moves against you, and then the trend changes. And that exit level may be adjusted later in the trade, as long as the trend is still valid then.
All right, so let's relate that back, Cameron, to stops and this kind of overarching idea of exit considerations. How do we put this into practical application?
Hey, yeah, let's talk about applying it. By using the if this then that model, a trader can really distill the decision-making process down to a simple sentence or an algorithm. If the stock hits X price, then exit the trade. If the stock falls below X price, then exit the trade. That sort of simplicity may help to remove emotion or other external factors from the trader's mind when they're planning that exit strategy, Ben.
Right. So it sounds like that simplicity kind of eliminates maybe some of that emotion. We talked a little bit about that before, and it certainly sounds like emotions can be the biggest barrier, perhaps, to exiting a trade at an appropriate level. But isn't emotion just human nature? Is there a way that we can get away from that?
Well, yeah, it probably is just human nature, but in a way, yes, we might be able to get away from that. But we've been learning to make informed decisions using simple if-then conditional statements, and we've been stringing them together into a set of trading rules. Now, we're really just reprogramming our human computer with the algorithms that we've established here, Ben, to select, enter, and exit trades.
You know, I get that, and I like the idea that we take some of that emotion out of the equation, and we become a bit more methodical in that approach, and that's pretty cool. But I'm assuming that, like with everything else, there are certainly pros and cons to this approach to exit, right, Cameron?
Yeah, absolutely. If this, then that is just the way to logically structure the trade. The trader still needs to put in the work to determine things like trend, support and resistance, risk tolerance, and their position sizes. This is not a guarantee of success, and of course it requires discipline. So I don't know whether that's a pro or a con. It just depends on how disciplined a trader you are. And there are other ways that we might approach exits, Ben. But if we do use if this, then that when planning a trade, it may be easier to cut through all the other stuff, the emotions, the ego, the mythology, by building a set of conditional statements that react to what's actually happening rather than what we wish or hope or pray or fear might be happening then.
You know what, Cameron, that's a great crystallization of this idea. I know we use that word a lot, but I think it is a good reminder, and thank you for reminding us about the if this, then that methodology, about exit considerations. So Cameron, we're going to leave it right there, but we'll revisit this topic often here on Your First Trade. And in the meantime, Cameron, stick around for a little bit. We'll build a more complex if this, then that trade later in the show. Now, coming up, we'll review some of the trade exit tools on the Thinkorswim platform. So stick around.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back to Your First Trade. Now, we've been talking about exit considerations today and the use of stops as a tool to facilitate trade exits. So let's review what some of those tools look like on the Thinkorswim platform. So follow me down to the platform and we'll take a quick look. And we're going to start on the Monitor tab as we look at a number of the positions that we currently have on, and some of those don't have stop orders. Some of those do have stop orders already in place. So the first one that we're going to look at is a stop order that's already in place on a trade that we have already placed. And we'll just take a look here at FCX as a symbol. Whenever we look at an individual symbol, remember that it is simply an illustrative and educational example and not a recommendation. So we can simply move our cursor over to the left, hover over that order, and click to see the information about this order. This is a market stop. It says trigger this order if the price of the stock drops below 37.84, then exit the trade by submitting a market order, that basic if then else methodology. And we can change this order if we want to simply by right clicking and clicking on cancel replace order and making any adjustments that we need to on that order. So we're not going to do that right now, but I wanted to show where that stop loss is visible. We can also see that stop loss order up here in working orders, and we can find it by the symbol. And again, we can see that that is a stop market order with a time in force of good till canceled. That's a typical stop order used to exit a position. If the price breaks a certain level, then exit the trade. Now, let's go back to our position statement here on the monitor tab, and let's take a look at a stock that does not currently have a stop order in place, and we'll place an order based on exiting the position, and we'll scroll through some of the exit tools that are available here on the Thinkorswim platform. So we're simply going to pick in this list, let's pick example BAC. This is Bank of America, and we'll simply notice that over on the left-hand side, we do not have a stop order in place. So we'll pop over to the charts, and we'll put in the symbol BAC. And we notice that the price of the stock is moving down, has been in a short-term downtrend. So the next thing that we're going to do is identify a level of support below which we want to get out of the trade. And so in this particular case, we're going to identify that level as a level of support that exists off of this little bounce back here in December. So if price breaks below that level, that's our line in the sand. That's where we're done. So that line is at around 31.45. So the first thing that we can do is we can create a stop market order like the order we saw on FCX. We'll go to the trade tab for BAC, and we'll simply create an order to sell by left clicking on the bid price, and we'll come in here and we will make this a stop order, and we will trigger that order. We'll just cross check against our charts. That price was 31.47. We'll come back to our trade tab and we'll adjust that stop to 31.47. Now that's a stop market order. Triggers at 31.47 and then becomes a market order. That's not a guarantee of where that order may be filled. The price of the stock could be moving and it would be the next available price. Now, if we were to change that to a stop limit order, we could specify the range in which we want that order to get filled. So trigger the order at 31.47, but don't fill the order if the price goes below $30. Now we've got a range in which that order can fill. But there is a possibility that the price could gap down around that price. And if it's below $30, the order would activate but not fill because it would be below our limit price. That's another type of stop order. Now, we can do one more type of order here, and we could choose a trailing stop. And we talked with our friend Barb Armstrong a couple of weeks ago about this idea and using a trailing stop. A trailing stop ratchets up with the price of the stock and does not ratchet back down. So we may be willing to place a stop at a certain level below or a certain price below or a certain percentage below the current price of the stock. So we'll choose now a price below. We'll simply put in a trailing stop $1 below the current price of the stock. That always ratchets higher, never ratchets lower. We'll change that time in force to good till canceled. One of the challenges with a trailing stop order, however, in exiting a trade is that it ignores levels of support and resistance. So it's up to the trader to decide if that is an appropriate order type to use. Now, if you have questions about these or any other order types on the Thinkorswim platform, you can simply go to the Education tab at the top of the platform, and you can then select in the Learning Center and search for stop order types, and you'll be presented with a glossary of information about those different order types, as well as educational videos that can help you to define and understand those types of orders as they are placed in the Thinkorswim platform. So a great learning tool to be able to reinforce the ideas that we've been talking about regarding stop orders and exit considerations. So coming up, we'll build a complex if this, then that exit plan with our good friend Cameron May. So stick around.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today. Welcome back to Your First Trade. I'm Ben Watson, and we're continuing our discussion of exit considerations and stop losses, and I want to bring back in our good friend Cameron May. So Cameron, let's talk about a trade that has both a target exit and an exit on a stop, and I think that gets to the idea of planning both an upside and a downside exit, Cameron. So can you give us some insight into creating this type of order and maybe an if then else that, or excuse me, if this then that statement for that type of trade, Cameron?
Yeah, sure, Ben. So here we just construct two if this then that statements, and we connect them with the conjunction or. For example, if price hits $100, then exit. Or if price breaks $85, then exit. So this process, typically starts with identifying support and resistance levels. So let's check out ANET. Once we've determined our profit target level, maybe a level of resistance near $154, we can set a sell order there. Then once we see a near-term support at, say, $143, we'd likely place a stop below that level. For example, maybe 1% below that level, Ben.
All right, so the first order is the stock hitting a resistance or a target, and the second is the stock breaking support. That speaks to some of the things that you were talking about at the beginning of the show in addressing taking the trade off perhaps too soon and maybe waiting to take the trade off too long. It seems that those two types of orders make sense, right?
Yeah, absolutely. Yeah, from there, it's really easy to take the if this, then that statements and build that order, Ben.
All right, cool. So follow me back to the platform and let's see how we would create this set of orders. We'll drop right in to the chart of Arista Networks, ANET. Again, remember, anytime we look at a symbol, it is for illustrative purposes only. And I'm going to look at some of those levels that Cameron mentioned. And we simply took a measurement technique from this price pattern that the stock is creating and the breakout, and we found a level of resistance or potential resistance up around that 154 level. And we have a level of support that the stock just broke through at around the 143 mark. So we'll use those to create our if-then-else statements that we're going to link together with that or statement. So what I'm going to do is I'm going to do this right from the chart so that we have that information there. We don't currently have a position on this particular symbol. So we're going to right click on the chart and we're going to buy custom with OCO bracket. So the first order is the order to get into the trade. The second order is going to be the order to exit if the price of the stock goes to that target, which we said was at 154. So our first if then else statement is this: if the price of the stock goes to 154, then exit the trade. So we'll change that time in force to good till canceled. And then the second if then else statement that we're connecting with an or conjunction is or if the price of the stock drops below 143, now we'll take that 1% below, so we'll go right around 142 or so just for easy math. So if the price of the stock drops below 142, then exit the trade, and we'll change that one
Stop filled.
to good till canceled as well. So here are our if then else statements. If the price of the stock, once we enter the trade, if the price of the stock goes up and hits 154, then exit the trade. Or if the price of the stock drops to 142, then exit the trade. And we call that an OCO, or one cancels other order. So we click on confirm and send. We read the alert, make sure that we understand that those stop orders are not guarantees and that there are risks. We click on send, and now we can see that order on the chart. We can go to the monitor tab, look in working orders, and you can see that those are connected together with that or conjunction. So our if then else statements connected to create this order to exit if the price goes up and if the price of the stock goes down. So Cameron, that seemed easy enough. Any final thoughts on exits, on stops, on exit considerations, on these ideas as we put this together this week on your first trade? Cameron?
Yeah, definitely, Ben. I just want to leave our audience with the idea that traders who practice disciplined risk management are less likely to be influenced by things like greed or fear. By setting risk limits and sticking to them and planning exits, traders can protect their capital and avoid making impulsive decisions based on their emotions, Ben.
Yeah, you know, Cameron, it seems that this is the next logical step in this idea. So we started this week talking about discussing how we go about finding stocks to trade, the methodology. And in fact, you shared with us the idea of using that top-down approach. And we continued that with the idea of developing our entry considerations checklist. Yesterday, we talked about the idea of risk management and understanding how much we're going to trade. This is a great discussion about today, making sure that we have a clear plan for exits and some of the tools in which we can do that. And tomorrow here on Your First Trade, as we wrap up season 1 trading stocks, we're going to answer the question, what are some of the next steps to take in this process? So Cameron, this has been some great information. Any last words you want to leave about this idea of placing your first trade?
No, Ben, I just want to emphasize the importance of having a plan for placing that trade and then just sticking to it. That really is where where consistency comes into play, and then we can just revisit whether we're on the right path.
Cameron, great information. I want to thank you for being a part of this discussion throughout this season. So you can follow us on Twitter at @BenWatson_TDA. You can follow Cameron on Twitter at @CMay_TDA. And for more education resources, check out our library of live and recorded webcasts on our YouTube channel, youtube.com/TD Ameritrade. And as I mentioned, on our next episode, the season finale, we'll explore next steps for you to place your first trade. So thanks for tuning into Your First Trade. Make sure you tune in every weekday at 4:30 p.m. Eastern Time, and we'll see you next time.
Good afternoon, traders, and welcome to Fast Market. I'm Tom White, and we've got a great lineup for you today, including discussions and strategies in CrowdStrike, which is down about 8% so far this week after its investor briefing presentation, and Target, which has rebounded about 9% so far this year. And like Folio, we'll break down consumer sentiment data on Lowe's in the home improvement space, which has flatlined from year-ago levels. Now, 2.5 hours into the trading day, stocks are basically around the flat line, but off of session lows, as signs of a potentially weakening labor market fueled fears of an economic downturn on the horizon. The latest weekly jobless claims came in higher than expected, adding to recent signals that pointed to slowing job growth. Now, let's take a look at the 4 major indices, which, as I mentioned, are off of session lows. The S&P 500, the benchmark, now up over 0.1%. The Dow Jones Industrial Average lagging down about 32 points or 0.1%. NASDAQ 100, big reversal here, now up nearly 0.5% on the session. And the Russell 2000, the small caps, just above the flat line, slightly in the green. And to help me break down this market action, let's bring in my co-host, and that's Kevin Hanks. Kevin, jobless claims, another jobs number that's basically a little bit worse than expected, what the Fed wants to see, but there were some big revisions.
Yeah, they kind of flipped the script this time. How do you go from really strong to, whoa, not so strong?
Right.
What do? You put up a 228 and you revise last week's up 48,000 new entries for first-time filers for unemployment insurance. So now the 4-week average went from 198 to 237. So that's a fast jump in that number.
They did note that seasonal adjustments affected numbers. So there might have been some miscalculations over the last several weeks where we saw those low numbers, but they were actually supposed to be higher. So maybe that came into the revisions that we saw. But I mean, I don't know who's to blame on that, but it's also reflective.
So we can't trust the numbers we're getting from great. More good data. We can get
I'm not
data,
saying that.
We can get economic data in seconds from all over the world, high frequency, everything, yet we still can't get real-time data on things like jobless claims or any real employment. It's unbelievable how stale some of the economic data we get is. Even payrolls is mid-month, right? So things can change right. It's amazing to me that they can't do a better job of making this more high frequency, more at the moment.
So maybe some of those numbers under 200,000 a week that we have seen over the last several weeks, they said there were made slight revisions across the board there, but just goes into that narrative that the jobs data that we've been seeing is what the Fed wants to see. We're starting to see jobs data crack a little bit. Started with the jolt. ADP came in lower than expected, and now jobless claims.
3 for 3 this week.
Yeah.
So now what does that say? We're looking at an expectations tomorrow of 240,000 in terms of payrolls and 3.6 unemployment. You got to think that means lower payrolls and higher unemployment. So if you're watching the numbers tomorrow morning, that's what you're looking for. 240. Can think about lower than that. 3.6, think higher than that. And then wages. Wages, the expectations are for 0.3 and 4.3 versus 0.2 and 4.6 a month ago. You got to watch the wages data because the bonds will trade up that. But Tom, here's the thing. We've got a little recovery this morning in stocks after a down opening. And that is closer in line with what the dollar and yields say the market should be doing.
Right.
So maybe it's just taken a little bit for it to get to that, to where people feel good about lower rates or lower yields and lower dollar being favorable for stocks.
Right, yeah, because we had talked about and discussed that over the last couple of days where they've kind of diverged, where bad news is actually good news for stocks a little bit as we're off those lows. But one stock that's taken on the chin today, down over 2%, is Costco. Let's bring in Renita Young, senior markets correspondent here on the network, to help us break down these numbers. More same-store sales out of Costco, but they're trending the wrong way. But, still, comparables are pretty tough from last year, Renita.
Oh, a lot of things are pretty tough with Costco. This morning, those shares are falling, just as you said. Same-store sales dropped for the first time in almost 3 years, and the company's sales growth was the lowest it's been in almost 3 years. Those are two huge problems, and they signify that the consumer is starting to hold on to the money a little bit tighter because of these macro conditions. But let's take a look at the numbers. March net sales came in at $21.7 billion. That was just a 0.5% increase year over year. And when it comes to U.S. same-store sales, they dropped 1.1% in March, down from a 3.5% rise the month before. And of course,